So good morning. Welcome to our COVID-19 Economic and Superannuation Update. I'm Olivia Long, Managing Director of SMSF at Prime. Today's host will be Jonathan Bayes, our Chief Investment Officer, and we'll also be accompanied by Mark Johnson, Partner from our Wealth Division, to answer any Q&As that we have at the end of the session. Before we commence, just by way of housekeeping, we do encourage questions throughout the session. So if you toggle on the middle of your screen down at the bottom, there's a Q&A tab. If you've got any questions, just click on that and send them through to us as we go. We will attend to them all at the end of the session. Questions are encouraged, so that's what we're here for today. On that note, I'm going to pass over to Jonathan and enjoy the session.
Thank you, Liv, and good morning to everyone. Thanks again for giving up your time with us. And for those of you that are back for a second or a third time, thanks again. I've tried to change the presentation up a little bit again this week, change the focus again with the data chopping and changing so rapidly on a weekly basis or so. I thought it was pertinent to try and give you guys as up to date a sense for how things in the economy, both here and overseas, are looking. Hopefully, I've just launched the presentation. Everyone can see it now. So again, without further ado, I'll just sort of kick off. Usual disclaimer here: this is general advice and not to be taken for your own personal situation. Please advise on that. And off we go. So again, I will reiterate that the big theme that we're really trying to embed in portfolios at the moment is one of resilience. We believe that we've got a pretty tricky 12 months or 18 months, in fact, in the local economy particularly, but also too in the global economy on account of the impact of the virus and the social distancing and shelter-in-place restrictions, which I think are likely to be with us for some time in various forms. So we think that investors are going to value certainty, cash flow resilience, balance sheet resilience. We think that in the current world there's too much debt, whether it be government debt in places like Europe or in the States, in the United States, at a municipal level. Whether it be from a household level here in Australia, which is where we've got the most leverage, and also obviously in the States as well at a corporate level. And when you have too much leverage and you've got a declining top line, it's an uncomfortable situation. And we think that for that reason, you're going to see a big sea change in the way businesses are run, and they'll be run for resilience, as I say, rather than efficiency. And that means that equity investors, equity holders, are likely to see diminished returns. We also think that there's going to be excess capacity, unfortunately, in the world, and that'll be structural unemployment, with a variety of industries seeing a structural change in employment numbers, but also to a likely impact on demand that's coming through, meaning that again, it's unlikely that you'll be able to get that operational efficiency through businesses in an environment of diminished demand. So these are the themes that we've spoken to in the last sort of 5 or 6 of these presentations. So I've tweaked these a little bit, but just repeating what I've just sort of said. The world's got too much debt at the moment, and for a period of subdued demand, equity returns, we think, will suffer as businesses are run for resiliency, not efficiency. This is a really burgeoning theme that you're going to find a lot of people writing about. They've called it the 90% economy, and there's a fantastic article written in last month's Economist talking about this. And it's pretty intuitive, I guess, when you think about it. You only have to go to Coles or Woolworths and see the amount of space that people are having to keep between them. Everything is going to be less efficient. Things will take longer to do. Many service sector businesses will sadly go bust because when your movement is restricted and things take you longer to do, invariably you might choose not to do them. Again, the structural unemployment theme is a big issue, I think, for economies around the world. And this idea of resilience, which I've talked about a couple of times already, is really important because in a world of zero interest rates and you know, the path over the last decade to get to zero interest rates has seen you know, a huge amount of leverage taken up in the system because it's been the right thing to do. We've had reasonable growth, particularly the last 2 or 3 years since President Trump was appointed. We've had slightly better growth. And with really low interest rates, there's been a huge incentive for people to take on leverage, businesses to take on leverage, to make good returns. And we think that again, with the uncertainty created by the coronavirus, the shock that we've seen to supply chains in the last couple of months, the shock to balance sheets that we've seen from the cessation of business and household cash flows, is such that people are going to run their balance sheets at a corporate and household level with less debt. We're going to see businesses run less lean inventory to ensure that they have got stock on board should we get another shock. And as I said before, that just means that return on equity is likely to suffer. You know, we're taking the view, and again, a lot of this really stems on progress that's made in terms of finding a vaccine or some sort of treatment that means that once you go into a hospital, should you get a severe case of the coronavirus, or that you're out a lot quicker and with far less damaging after effects. We're still a ways from that now. Anthony Fauci last night was quoted in his presentation to the Senate as saying he couldn't see development of a vaccine by the autumn in the United States. It's quite a remarkable sort of thing that I'm even referring to that, given that we've never found a vaccine for a coronavirus before. But these are special times. But even still, that optimism that has been evident in markets perhaps looks a little bit overconfident. He doesn't see it happening certainly in the next 6 months. And so it means that really, even though we're coming out of social distancing and shelter in place orders here in Australia and around the rest of the world, we're going to see the effects of them continue for some time yet. And that's really the message to get across. The rest of these things I want to just scan through with you to bring you up to speed on some indicators that we're continuing to follow, and you know, some themes that we think are pertinent for putting portfolios together. The next 2 or 3 charts are really simple, guys, just to give you a really simple, colourful picture to show you where we are in the virus's sweep, if you will, through the United States. Emerging markets are really the hotspot. I'll refer to them in a moment, but you know, as we see many states in the United States exit shelter in place, you know, the question is, well, where are we in terms of the virus's spread? And you can see there the focus should be on the green dotted line, and that is the death toll in the United States, excluding New York and New Jersey. There's been, you know, a lot of press saying that the caseload and the death toll is flattening out in the United States. And technically that's correct, and it's largely because the numbers in New York and New Jersey have flattened out because they've taken some quite strict, albeit late, measures to contain it. Elsewhere in the United States, there is no flattening whatsoever, and that green line depicts that. That is a point of concern, or should be a point of concern for a lot of us, because you know, again, America is trying to go back to normal in many of these states, but they're doing so without actually having flattened the curve. And the risk, if you read a lot of what the experts in the states are saying, is that you know, take a 28-day infection period at its longest, you know, as people start going back to their regular daily life, we should likely expect to see an uptick again in infections towards the back end of May and early June. So that's that runs the risk of seeing a 180-degree turnaround in the easing restrictions potentially in the US, and I think that'd be quite damning to consumer confidence. The chart on the left is just breaking the states out, and again you can see there's really precious little flattening going on at all in many of the states outside of New York and New Jersey. I'll let you potter through that. Again, the presentation's available for everybody. Once we're done, I'm happy to send it through. And again, on the right-hand side, you can see the case numbers there. The dotted red line is the United States ex New York and New Jersey. Again, we're well through 1 million cases in the United States and just short of 900,000 ex New York and New Jersey. But remembering that in the United States, there's 360 million people. So still an awful long way to go in terms of, any concept of herd immunity that people are talking about. We still only really scratched the surface of the infection rate. Now the concerns in the world have turned to the emerging markets, and it is concerning and potentially as big a tragedy as what we've seen in parts of the United States. You can see the yellow line there is Brazil. They've got a president who has largely ignored the threat, and unfortunately they're increasingly paying the price for that. And you've probably all read in the press over the last couple of days that Russia has also seen a massive escalation in the number of cases, which is obviously very unfortunate as well. That's the last you're going to hear from me. I'm almost to the point where I'm a little bit sick of talking about the coronavirus, as I'm sure a lot of people are, not to be flippant, but they're the last of the charts on that, and hopefully we can focus a little bit more on the data and on how we're putting the portfolios together. I say that the US is a beacon of optimism, and everything is relative at the moment, but it really is quite true. In Europe, in Australia, certainly in China through February and March, we've seen a capitulation in demand, in economic confidence, to consumer business level, to levels akin to the GFC, or in many instances, certainly here in Australia, worse than the GFC. In the US, a lot's been made of the unemployment situation there, and consumer confidence has been slow to roll, but has started to roll up as well, and manufacturing data has given up the ghost in the very near term. So it's not to say that they've not been impacted at all, and again, you can see the jobless claims figures over the last 7 weeks there. There's 160 million people in the US labour force, and we've basically had 33 million of them sign on for the dole in the last 7 weeks. So there is an impact, but the impact is very much in the immediate term. There is a huge confidence in their ability to overcome this in a very short time. And I'd be speculating as to why that might be the case, but potentially it's got to do with the message that's being sent from the White House to the population. But these two charts demonstrate to you that there is a real belief at this point in time that on a 6-month view, we'll be past this and it will have no real lasting damage on the economy. Now, I know there's a lot of headlines from market commentators and, probably including people like myself who, view that that optimism with a very healthy degree of cynicism, but you can't argue with the data. And on the left-hand side is data that was out last night from the NFIB, who run a monthly small business survey. And the left-hand chart is just the outlook for general business conditions. And believe it or not, that's an 18-month high. So the immediate index of how things are is obviously at a very significant, significantly lower level than it's been at any point in the last 5 years. It's not at GFC levels by any stretch, but it has significantly been impacted. But on the outlook view, the survey respondents, as you can see by the number 29 there, are more optimistic than they've been in 18 months from an outlook standpoint, which is fascinating to me. And on the right-hand side is a very similar a survey, this one done by the Philadelphia Federal Reserve Bank. Again, it comes out every month. And this one's the 6-month forecast for general activity. And you can see again there, barely changed. So there is a real confidence, as I say, that this is something that will be very easily overcome. As I say, I feel like it's a very naive view. And I think that the real risk, unfortunately, is that it's revealed that this might not be something that they sail through, that that the despondency created in the consumer actually might lead to maybe even a more negative outcome than that which I'm expecting. But you can't deny they certainly have a view that we've all heard the term before, American exceptionalism. There is certainly a view that they will come out of this on the other side a lot quicker than perhaps the view of those in Britain or Europe or even in China, in fact, who are recovering, or indeed in Australia. You know, I'd say the first recession in 30 years. I think that you know, there's every likelihood we're going to get a couple of quarters of negative growth coming through. And this is one of the charts that I actually included in the presentation from a fortnight ago, but it does give a good lead off. This is a leading indicator of where the economy is going. Westpac run it every month, and you can just see there that we're basically at the lowest point we've been at this century, at a lower point than the GFC. And there's a few reasons for that. You know, this is just, again, some data out from the NAB business confidence numbers that came out yesterday. I'll actually start on the right. I should have put this one on the left, but the right-hand chart is actually the business confidence figures. And we did see a small bounce last month, which is great, but you can see the small bounce is still significantly below where we were at the low point in the GFC. And on the left-hand side, maybe more pertinent for the economy is just the measure on business capex. And you can see that fell away even further last month. So businesses are really going into protection mode. And that's going to be something that's very difficult for the economy and indeed for the government to overcome. I'll explain this chart just because I have inverted one of the series, but hopefully it'll make sense to everybody. It's Australian wage growth, which is the red line, on an annualised basis, and the axis on the left-hand side has been inverted. So that 2.2% annualised has been inverted. And the white line is just a combination of unemployment in Australia and underemployment. So prior to the April data, which is actually due out tomorrow, which will see a big spike, you know, the number of, or the percent of the labour force that is either underemployed, so not doing the hours they want to do, or unemployed is 13.7%. And in tomorrow's numbers, I'd imagine that combined figure will probably push up to 17% or thereabouts. And you'll see from the chart that'll be a new high point for the last 20 years or so, probably even well past the last 20 years, back to the early 1990s recession. But that will, even at 17% or at 13.5% or wherever we are now, the higher that goes, like any market, indicates an excess capacity of employment, and that will lead the price of employment, which is wages. So as we see the white line spike up to the top right-hand corner, I would expect that the red line in the coming couple of months will follow suit. And remembering that I've inverted that chart, that means that average annual wage growth will fall, I think, well below 2% on an annualised basis in the next 6 months, which is something that, again, will be a real point of contention for the economy, for consumer demand. And again, when you see a diminishing annual wage growth in an economy, a consumer economy with a lot of debt, that will be, as I say, a real burden for us to get across over the next 12 or 18 months. I want to talk about housing a little bit as well. It seems to be everybody's favourite topic, so it's impossible not to refer to it. These charts actually came out yesterday. So I was very pleased when I was putting together the chart pack that I was able to include them. This comes from SQM Research. Louis Christopher is quoted in the papers constantly, probably one of the foremost housing market researchers in the market. You can follow him on Twitter, which is where I got these from. And this actually backs up some anecdotal evidence that I'd heard as well from one of the major real estate agents here, that in the last month, vacancy rates have exploded, particularly in CBD. In Sydney, in Melbourne and in Brisbane. The chart on the left is Sydney, you can see that, postcode 2000. The chart on the right is postcode 3000, which is Melbourne. And you can see the explosion in the vacancy numbers and in the vacancy rate to levels that we haven't seen again on this data measure, at least in 20 years. This is a combination of foreign students not able to come back and study. It's a combination of millennials who have lost their jobs and going back to live with their parents, etc. but this will have a knock-on effect to the housing market quite clearly. The housing market, I've referred to in previous presentations, I think is likely to see a 10 to 15% house price fall on a 12-month basis. I don't think that's a particularly controversial statement. Most of the major banks have included that in their base case scenario for the economy in the next 12 months, and certainly the auction clearance numbers would point to that being a sensible price retreat. And it would it only takes prices back to the low point they got to 12 or 18 months ago anyway. We've had a pretty amazing spike back up. So we're just rotating back to the lows that we saw 12 months ago, or we'll likely rotate back in the coming 12 months. And this is just building approval numbers, and they were already on the nose. Building approval numbers is the red line there. And you can see on the left-hand side, 8,500 approvals a month last month for private houses. Building approval numbers have apartments and private houses and commercial orders, etc. But this one is private houses. So you can see that the number there at 8,500 has come off. You know, what was virtually 10,000 approvals a month for the better part of 3 or 4 years there, from 2014 through to 2018, as interest rates were cut. And we've obviously softened up quite significantly post the Royal Commission and the impact that had on lending from the banks. But the great likelihood, I think, is that we'll see approvals drop to, you know, the order of 7,500 a month, which is another 10 to 15% fall from where we are. And you can see the white line there. That is something that's a data series that comes from the Australian Industry Group each month on a variety of industries. This one is new orders for houses. You can see how it collapsed last month. It's a great lead indicator for building approvals. Building approvals are a great lead indicator for housing construction. This is a point of concern. We've raised this over the last couple of years as construction rates have fallen as an issue. Unfortunately, it feels like it's going to worsen. And it's a bit of a problem for the economy because construction comprises about 10% of the total job market. And when you throw the retail and accommodation and food services jobs, which obviously have been impacted by the quarantine, you know, construction's 10%, retail, broadly speaking, I think is 10. I might muddy my numbers up here again. I should have them written down. And accommodation and food services, I think, is another 7 or 8. But either way, you're talking about a quarter of the jobs market in those 3 industries. It's not ideal. And just to round things out, why I think, you know, again, it's important for us to just be cognizant of what's likely to happen here in Australia, is that we just don't have the policy levers to pull to avert, you know, an economic nosedive, which, you know, obviously is going on everywhere in the world right now. But back in the GFC, we had interest rates to cut. We had fiscal stimulus to spend. You can see there, you know, post Costello and Howard, we had net cash at the government balance sheet. Now we don't. In fact, debt's on the way to $600 billion. We've got household income, which is obviously pushed higher in the last decade as interest rates have fallen, and we've taken on more debt to income, given the lower interest rates, to largely buy housing, but really in a broader sense to sustain a living standard that we've arguably as a country come to accustom ourselves to. The currency was significantly higher back in 2000, 2008, and even got above parity to the US dollar in early 2001, and is now obviously at 64, 65 cents. So we don't have that as a potential stimulant for the economy. And lastly, whilst things actually have normalized to a large extent on the industrial front in China, you know, you go back a decade and China was producing half the steel a month that they're producing now. And inventory is also high. You know, again, the Chinese steel mills, whilst they're up and running again, which is fantastic for iron ore, they're not going to go and increase infrastructure in China again by another 50% to bail out, you know, our iron ore producers and our trade accounts. So at the moment, it's hard to see what's going to be the likely stimulant for the economy in the very, very near term. So from an equity market standpoint, just a couple of things that we're looking at, and I think the next couple of charts will give you some context for the degree with which earnings have been cut. But also, particularly, I just want to show you the cut in dividends as well. Now, this is the US market because I can't get the dividend numbers in Australia to hand quite as readily, but this chart makes the point that I want to reflect anyway. You can see the white line, that's the S&P, and that's the broadly speaking corporate earnings for the S&P, which have fallen from low $190 a share to 160. So broadly speaking, they're 15% or so cut for 2021 earnings. The cut in 2020, the current year, has been far more significant, almost 30%. But in 2021, next year, with a little bit of hope that things normalise and look a little bit better, the earnings cuts are only 15%. But on the red chart, that's the dividend futures in the S&P. And basically, that's the forward outlook for dividend payments in the S&P. And you'll see the cut there. Unlike the earnings per share figures of 15, the cut from 62, 63 to 43 is a cut of over 30%. And this kind of makes the point that I'm trying to reflect to everybody, which is that at the bottom of the capital structure, in a time of weakening demand and high leverage, equity holders are the guys and girls that get to hold the can. And you can see there that the dividend cut is far more significant than the earnings cut. And that's because the additional earnings are being used to bolster balance sheets. So, again, with leverage, companies are paying out less as dividends because they want to pay their debt down. Okay? And the point is exactly the same in each of Europe, Japan, and Australia. But I thought that chart in the US makes the point pretty well. This is actually the earnings per share in the ASX 200, just to give you that context again. The white line is the earnings per share number, which you can see has fallen, broadly speaking, by just under 30%. The share market's obviously come back, a little bit less than that, particularly with the bounce. But again, with the banks in particular, holding off on the dividends in this six months, and I suspect potentially in the second half of the year, and this being seen as a green light for other companies to do much the same thing. What has been historically a market well regarded for its dividend capabilities, the Australian market will be bereft of major dividends, I think, in 2020, unfortunately. The other thing that we think is really pertinent in the market at the moment, both here in Australia but also too globally, is the gap between perceived growth stocks and value stocks. You can see the orange line that's up on 27 times current earnings is an index that MSCI builds, which focuses on growth, earnings growth, as an investment theme, and the yellow line is value. And so what we're seeing right now, arguably to the widest extent in over 50 years, is that with the decline in economic outlook, but with the huge amount of liquidity that's been injected into the market by central banks around the world, investors are paying up for what they perceive to be a certainty of growth. We refer to companies that grow irrespective of the economic cycle as those with secular growth. So in Australia, the classic ones would be CSL or ResMed or Cochlear, companies that can grow because of something that's structural in their industry, irrespective of what's going on in the economy. In the United States, it'll be the big tech companies who've pretty much sailed the last month or two through the crisis without a major impact other than maybe on advertising revenues in Facebook and Google. And so those value stocks, which is likely to include oils and banks and companies that are exposed to the economy, are obviously languishing. But the gap between growth and value is now as wide as it's been in performance terms in 50 years. And that leads to, again, the question that we're constantly asking ourselves which is, the risk associated with paying up for that growth and being disappointed if it doesn't come through. as contrasted by the value companies, which are surely having a pretty tough time of things at the moment, but they're being priced accordingly. And this makes it for quite a tricky market in the next 6 or 9 months, because there's an awful lot of crowding going on at the moment in these favourite stocks, and the market has a very regular habit of coming out and shooting consensus positions when they get a little bit too warm and cozy. And we think that increasingly there is some risk in some really rather highly valued companies that people are overvaluing that certainty of growth. China, only a couple of quick charts here just to scan through these things. It really is the one beacon of positivity. But again, at the same time, I don't want to get overly optimistic about it, because everything's relative. You know, I've referred to the TomTom traffic data in the past. These, again, just as a recap for everybody, the red line is the average traffic congestion in Beijing this week, and the dotted white line is back in 2019. So you can see the red peaks are virtually back at the levels they were at in 2019, barring Sunday. In the presentations from a fortnight back and a month ago, I was sort of demonstrating that we were pretty much back to where we were, but on the weekends, people weren't going out. They're slowly but surely starting to go out a little bit more on the weekend. The trust is starting to build up, and that's an encouraging thing. And the next chart, even though it's not China, I wanted to bring up because it does make the point, I think, that that China is recovering, but the rest of the world's having a problem. The data on the left is Milan. And so obviously they're only just starting to ease up on restrictions there, but you can see significantly the weakness in traffic congestion, and the right is Paris. So I just wanted to bring them up just to prove the point that China and Beijing and Shanghai and all the major cities in China are starting to go back to work. On the left-hand side is the service sector indices out. The white chart is from the government. The red chart is a private sector data release, reminding everybody that above 50 is positive month on month, and below 50 is negative month on month. This is just the small relative caution to say, yes, we're going back to work in China. You know, effectively in a command-controlled economy like that, they can pretty much say you've got to go back to work, and so people have been. That's why traffic data the last month or two has improved during the week, but been pretty slow on the weekend when people have got the ability to do what they actually want to do. It is improving, definitely. We've had a bounce back in the service sector economy in April, but you'll see the white line there, which is the government statistics, are claiming that it's back up month on month. They have a habit of being manipulated. The red line is the private sector data, which definitely rebounded last month, no doubt about it, but at 44.4, it's still modestly down on the previous month. It's just not as bad as it was the month before. And the chart on the right, which is also, you know, modestly encouraging, does actually point to modest month-on-month growth in small business confidence, and that's a private sector data release, comes from Standard Chartered. So the Chinese economy is slowly but surely coming back to life, but as a very big export economy, it really matters what the rest of the world's doing, because you can produce all that you want, but if the demand doesn't start to come through, well, then we've got another issue again from a deflationary standpoint, where we've got too many goods and services that people don't want. The last little theme I wanted to focus on, because again, much like housing, it's something that people like to talk about, is the Australian dollar. Again, it has an impact on our portfolio and how we look at things, in particular on international equity holdings, which have been a big part of portfolios for us, and I think increasingly for most Australian retirement incomes as well. They've been really the best asset class for the last 5 years. So the Australian dollar does matter, because almost half of the returns that people have made over the last 5 years in holding funds like Magellan or what have you has come from the weakness in the Australian dollar. And we're a little bit worried that in the very near term, the currency here in Australia is bottoming out. And there's a couple of reasons for it. I don't think we're going to see it race away to 80 cents by any stretch. The economic outlook in Australia is a cautionary one. But in a relative sense, which is something that we've all got to remember in currency terms, everything is relative. We're coming out of the social distancing lockdowns a little sooner than everyone else. We've done a pretty fantastic job here in Australia as well. So that ticks a box for us in terms of getting some semblance of economic activity up and going again. but also too on the trade front, you know, with the Chinese economy rebounding back and being the primary supplier of iron ore into China in particular, our trade balance has been pretty terrific because, again, with no consumer demand, all the goods that we import back, you know, again, our imports last month were very, very low relative, but our exports have rebounded back, and as a result, we had a record trade balance last month. So again, demand for Australian dollars on the up. So that's one factor. The other factor is that our central bank haven't been nearly as profligate as central banks in the rest of the world. And this is actually quite an easy chart once I explain to everybody. The white line is just the Australian dollar. So you can see we were down at 55, 56 cents through the maelstrom in markets in March. The orange chart is my crude version of what we call interest rate carry. So the difference between our interest rates here in Australia and the interest rates globally. And this one compares to the US interest rates. And so what we've got now is arguably the best relative value in our interest rates relative to the US interest rates in the last 3 years. And this will attract investment money and hence attract interest in the currency. And you can see that divergence we've seen in the last 6 months where here in Australia, relative interest rates have become much more attractive to foreign investors. And that tends to have a driving impact on the currency. And I think that will be something that pushes the currency as well higher in the next couple of months. You know, the Reserve Bank have done a terrific job in trying to support the economy over the last couple of months, again, backstopping the banks and providing liquidity provision to the bond market. But in a relative sense, they're doing far less than what the Federal Reserve are doing. And again, like any market, supply demand, they're not supplying as many Australian dollars as the Fed is supplying US dollars. And as a result of that, you can see that chart there has pushed the orange line higher. So that's another factor. And this just speaks to that point there. This is just money supply. The red line is the US Federal Reserve, M2. It's not quite apples and oranges. They're both good proxies for money supply. It's just that we tend to focus on M3 here in Australia, which is a slightly different measure of money supply, and in the US they're at M2. But the point is, in the US, the Fed have again pulled the bazooka out, printing money, stepping into bond markets, both government and corporate bond markets in buying bonds. And as a result, the money supply there is growing over 10% a year again, which is back at levels that you know, we haven't seen since the GFC. And here in Australia, things are definitely improving, but again, well below 5% money supply growth. And you can see too, which again, if you've heard me talk of this in the last couple of years, I've talked a lot about the very, very tepid growth in money supply here in Australia over the last few years as being a factor that's crimped the economy. And yes, things are starting to improve, but again, in a relative sense, you can see that white line is well below the red line. That's it from me. So maybe at this point, Liv, I might hand over to you.
No problem. If you could just move on to the next slide, that would be great.
Yep.
I'll take it from here. Thanks, Dono. That was really interesting today. Great work. So let's talk about superannuation, not just directly impacting on SMSF, but super in general, and some things that we'd like to consider. The first thing I'm going to talk about today is the $10,000 early access relief. So you would have heard that the government have allowed people in certain circumstances to access $10,000 of their superannuation prior to 30 June and $10,000 of from their superannuation between the 1st of July 2020 until the 24th of September 2020. So to be eligible to access this super under the early release, you must either be unemployed, be eligible to receive a job seeker payment, the youth allowance for job seekers with parenting payment, special benefits or farm household allowance. Or if after the 1st of January 2020 you've been made redundant, your working hours were cut by 20% or more, or if you're a sole trader, your business was suspended, or there is a reduction in your turnover of more than 20%. That's for citizens and permanent residents. Now, our advice, and this is general advice only, is do not access that superannuation money unless it's vital and you absolutely need it, because the long-term compounding effect is significant. You would have also heard, for those of you that are in pension mode, that the pension minimums have now been halved. we are continually being asked whether or not people can actually put that money back in to their super for those who have already satisfied their minimum for the year. The answer to that is only if you are eligible to make contributions to super. So unless you're eligible to make contributions, then unfortunately you are penalised and you've missed the boat on that one. You would have heard us talk about rent relief for related party transactions. So now we're talking about businesses who are leasing business real property, as an example, from an SMSF. The government or the ATO are going to allow a period of rent relief from the business to the SMSF. So there are documentation that you must actually complete in order to satisfy the compliance requirements around that. We now have access and can provide that legal documentation. So if you're impacted in that scenario, please contact us and we will provide that information to you to ensure that you satisfied your compliance requirements. People that have pensions, we recommend you talk to your advisors about stopping and restarting pensions where it may be appropriate. Obviously, we have a pension cap now of $1.6 billion at present, and stopping and recommencing your pension will actually reduce the amount that you've got in pension mode and enable you to increase that figure going forward. One thing that many people don't realise is that superannuation is not automatically dealt with as part of their will. So one thing that we recommend at this point in time is that people are looking at their death benefit nominations. It's something that you should be doing on a regular basis anyway. And in fact, even considering your SMSF trustee at present, and whether or not your trustee is actually up to date and allows for some of these changes that are happening at present. And finally, in terms of estate planning, you may know that one of Prime's areas of expertise is actually facilitating estate planning, and that includes preparing wills. It's prudent that everybody have a will, not just now, but at all times. And again, that's something that we can actually assist with if you'd like going forward. So we're now going to move on to Q&A. And we encourage people to shoot through any questions that you may have either in relating to super or investments full stop. And we'll bring Jonathan back onto the screen and also Mark Johnson. And we'll kick off the questions with one from William, thank you. He says, hi Jono, given you feel overall equity returns are likely to fall, I think you used the word detrimental. Do you think that the current trailing PE multiples are meaningless in terms of valuations? And is it extremely hard to value ASX companies given PE is so uncertain?
Will, absolutely. So I'll answer it in two parts. So it's a great question. We have had a month's impact on the Q1 figures in the results that we've had in the US companies and European companies, and a couple of the banks obviously have referred to the impact on their business. But I mean, this has been with us for 7 or 8 weeks really in a developed world sense. So it's only been a short period of time. And I think everyone is feeling around in the dark a little bit. Most people see the June quarter as being far more negatively impacted than the first quarter for the reasons I just sort of said. And we're not even halfway through May. So how things look, even in 3 months' time, let alone 6 months' time, are really hard to fathom. So it is hard to value companies. What we've tried to do, we've made some pretty significant changes to the Aussie equity portfolio. It's the only part of the portfolio we've had to change much of. We came into 2020 with a more optimistic view on the economy post the signing of the trade deal, and we've had to rethink that. And so what we've tried to do, Will, is to find companies that we think have less sensitivity to the economy, because we think they'll be the ones that are favoured by the market. So as a guide, we've had some changes to portfolios in recent weeks, and we've probably got a few more to come in the coming couple of weeks. So things like Coles has gone right up our list as a stock that we think is worthwhile having a look at. Good balance sheet, very good cash flow certainty, unlikely to see major downgrades. We think investors will go for that. Amcor had a good set of numbers yesterday. Again, packaging for goods that are in high demand in supermarkets and in hospitals, beverages, cigarettes, you name it, very steady business. The list goes on. Infrastructure names potentially, like something like a Spark Infrastructure we've been looking at, funeral operator like InvoCare, has a little bit of leverage, but far less than something in the construction industry or the advertising industry. Those are the companies that I think they're a little bit more predictable, and in certain instances you can buy them, we think, at prices that actually, even whatever your view on markets are at a headline level, we think that there can be actually absolute capital appreciation in them.
Okay. Next question comes from Mitch. He says, morning team, how do you see the convergence of the 6-month bank payment holidays, the 6-month government stimulus programs finishing, and a potential second wave with restrictions being lifted affecting the equities market domestically?
It's a great question, and to be honest, it's another reason why there's a huge amount of uncertainty, Mitch, because it's a bit like giving a patient in a hospital ward on who's terminal, painkillers, and so these stimulus programs both here and in the US are fantastic in terms of keeping the wolf from the door. And it also means that we've got a really interim period where we're maybe in the eye of the cyclone, and it doesn't feel so bad because there is payment protection plans in the US or the JobKeeper here, and so we're going to really see the whites of the economy's eyes in the first week of October leading into that, when JobKeeper ends. And if they bring it forward sooner, then we'll see it sooner. But these really very encouraging stimulus packages from governments around the world are really just, they're not stimulus, they are a bridge to the other side. They are something that gives the economy the chance to try and repair itself or prepare for tougher times. And so, if you look at the banks, they've all, and including Commonwealth today, they've all taken $1 billion to $1.5 billion of additional provisioning. They're trying to, again, arguably fix the roof while the sun is still shining a little bit, because the tougher times are going to come in early October once the JobKeeper here and in other parts of the world ends. Hopefully that helps.
Sure. So Mike from Perth says, which shares or equity categories are you forecasting will yield the highest return for investors, especially?
Mike, do you want to do that with the investment trust?
Yeah, I mean, at the end of the day, what we're looking at here is we want to be investing in businesses that have got defensive earnings, so that there's some reliability to their ability to pay out distributions. So some of the things that John mentioned a minute ago, just in terms of staple industries like supermarkets, Coles, or whether it's electricity distribution assets, where you've got constant demand, so you know that you're going to get, and you've got a regulated income, so you've got the ability to continue distributions. So I guess the overarching thing is we want certainty of earnings, which gives us confidence that they're going to have the ability to pay out those distributions.
Yeah.
So I guess that's, in terms of companies, that's the main thing. And John, if you're alluding to some of the debt LICs, they're another place where we're quite happy to be invested. And if you think about the difference between debt and equity, equity are the first people in the capital structure to feel the pain. But if you're investing in debt, you do have that protection of the equity investor taking the hit first. And in the case where you've got secured by assets or property, then you've got a loan to value ratio that offers 30% protection. And some of these things like a Qualitas or a Metrics, both ASX listed, so you've got the liquidity, they're offering some pretty attractive yields on more favourable terms as they get to dictate how money's lent in this type of environment. With yields 6-7%, and potentially improving. So there are opportunities out there, and I think we've been, conscious of that, conscious of the fact that a lot of people have got their money in super, entering pension phase, and that's where we're trying to position portfolios.
Yeah, spot on.
So another question from William is, have you looked at shopping centre operators, e.g. SCG and URW? Are they still too risky despite their share price being hammered? I looked at their latest updates and they were a lot better than expected.
Yeah. William, I've not really looked at them particularly closely. And again, in the companies like Santa or Unibail, I mean, they're great. I mean, you know, people like to shop, and at some point, again, hopefully we'll be able to do so without concern of getting the virus. But so valuation-wise, hard to know. But in the long term, yes, they'll be fine. We think, though, that if I make a general statement, in the next 18 months or so, I wouldn't think that there'll be really any upside in commercial property prices. I don't think. They've had a very strong run. I think retail in general is going to have a trickier time of things because, again, many businesses will unfortunately go out of business. I mean, and that will have an impact on retail tenancy payments. So our preference, if we're really honest, on the property front in the next 12 or 18 months is being in the debt. You know, you invest in property equity for a combination of the income you get and capital growth. But we've had a very strong few years on property prices here in Australia. And I think that it's difficult for me to envisage a strong continuation in commercial property prices in the next 12 or 18 months. And so if you can get the same level of returns from the debt, to Mark's point, where you're the top of the capital structure and you don't have concerns about, you know, about whether the value goes up or down. If you're the creditor and you're providing it with a, you know, and there's a healthy sliver of equity behind you, then, you know, frankly speaking, I don't know why you wouldn't just be in the debt. And that's where companies like Qualitas or Metrics, or on the wholesale front, CVS Lane or Merricks are really, we think, quite interesting sources of income.
Yeah. So the next question from Mitch is a good one, actually. I've had the same question brewing in my mind, and that is, with the potential of a worsening economy in the USA, do you expect the Australian dollar to strengthen against the US dollar in the medium-term future, back to parity again at some stage?
No. I mean, I mean, the Reserve Bank would all neck themselves if we saw the currency. I think even above 70 cents or 75 cents, the Reserve Bank will be very, very, very uneasy. And so, no, I mean, I think, you know, again, the currency is a function of many different things, but one of which is the relative strength of the domestic economy. And I think with a tricky time of things ahead, that will be a bit of a cap on some of the positives that I flagged earlier. I just think that the point we're trying to make on the currency is that we think it's bottoming out. It's been a huge source of stimulus for the local economy and a huge source of portfolio returns for Australian investors. And we think that that source of stimulus and return has now played out. And for the reasons I mentioned before, we're seeing a bottoming in the currency. And so I don't think we'll see it below 60 cents again. And if we do, it'll be very, very short term. And the bias from now, I think at 65, is to push higher into the low 70s. But no, I don't see us going back to parity. Certainly not in the next 2-3 years, no. That would infer that the economy here is doing far better than I envisage it to be doing.
Okay. So I'm not too sure who of you want to answer the next question from Satish, but any views on overseas businesses possibly moving out of China to other countries where there is an equivalent tech sophistication and the same or lower labour rates, like India or some Far East countries? And what would be the impact of that on us?
I mean, well, I can answer it quickly unless you want to, Mark, but you know, I think it's going to happen. I think Apple have already said or speculation is that Apple are trying to move some of their supply chain out of China into India. I think with everything that's going on in this last week on the meat export and the barley export side of things, that there will be increasing conversations about shifting our reliance on China, as indeed I think the Chinese are doing on the technology front with the US. So I couldn't be specific, Satish, on the impact, but I do think that the overall issue as we go from a couple of decades of globalization to a more nationalistic global economy, it means that people are going to want to, companies are going to want, and governments are going to want supply chains to be from parts of the world that they can trust. That means that, again, we won't be doing things purely for profit. We'll be doing things for certainty and national security, and invariably that means that there'll be a high cost to it, which means profit margins or balance sheets or what have you get impacted, and it goes back to my point on resilience.
Yeah. Anything to add to that, Mark?
It's the whole argument about the globalisation and just being the focus being cost efficiency, and now security of supply chains become more important as we've gone through the last couple of months, and that has an impact on the cost. So it's as simple as that.
Yeah. So Brian asked, do you believe it's likely that the odds will have another dip?
Well, I'd say it will today, Brian. I mean, not that I can see it, but yeah, I mean, the answer, I'm being flippant, but yeah, I mean, I find it hard to see in the very near term us going up, because I think ultimately share markets are a confidence game as much as anything else. And there's a variety of things that impact on an investor's confidence in a good or bad way, which then ultimately influences share prices. So in the last three or four weeks, the last 6 weeks, markets have bounced really strongly on the idea that central banks would stimulate the economy and we come out on the other side with what they're calling a V-shaped recovery. There's been a lot of optimism and liquidity driving that, et cetera, et cetera. But ultimately, other factors are at play, and people, often dismiss the link between the market and the economy. But corporate earnings have an impact, and your ability to service debt and the like. And my concern is that will be a trickier part for markets to contend with in the next 6 or 12 months. And so, yes, my base case, Brian, is that we're holding more cash at the moment because we think that there'll be better opportunity to buy things in the next 6 months or so. If you wanted to disaggregate the Aussie share market, you've got CSL, ResMed and Cochlear, which make up just under 20% of the market, all trading on the highest Ps they've ever traded on. Back to that point about value and growth, the growth stocks are trading on 50-year most expensive to value that we've seen. So I'd probably be taking the other side of that bet. Banks are getting closer to fair value if you want to take an optimistic view of things, but in a worst case scenario, they'd probably have another 10 to 15% downside. That's 20% of the market as well. So ultimately, Brian, I would say that I think that there's potentially 10% or so downside in the market. But beyond that, to one of the questions earlier on earnings per share, and it's very hard to predict at the moment because we are speculating a little.
Yeah. So I think our last question for the day comes from Tony, and he says, if Biden gets in, what are likely US economic policy changes and the likely effects in Australia?
Do you want to do that, Mark, or me?
Look, I'll start and you can finish off. But obviously, Trump's been very pro Wall Street. And then, if we have Democrats elected, then some of the concerns that market commentators are voicing in markets that will have increased regulation, we're going to have increased safety, health and safety issues to contend which will limit productivity. And you'll have potentially higher taxes to look at some of the debt that's been that's gathered as the US have sought to deal with the virus. So I think as the world's leading stock market, that if the US economy slows, then that obviously has an impact on Australia because they lead global markets.
Yeah. Yeah, I think the other thing to take into account, Tony, too, is that the tax rate will go up. You know, when Trump got in, he cut the corporate tax rate to 21%. We've now got, you know, an extra $1 trillion or $2 in debt, and it needs to get paid for. So there's you know, one of Biden's policies is that the tax rate will go back, I think, to 29%. That's a 10% cut to corporate earnings. So it's another risk clearly to the market.
Yeah. Okay, well, that ends our session for today. I'd like to say thank you to Mark, and a huge thanks to Jono, who puts a lot of work into this presentation. We will be sending you a copy of the video in the next couple of days, and we will continue to run these sessions, so you will see invitations coming through in the future. So between now and then, wishing you all the best. Enjoy the freedom that people are starting to get in some states, and we will see you again soon.